Their highly integrated semiconductor power solutions have helped Monolithic Power to a great growth over the last years. With customers like Nvidia, they could benefit greatly from recent investments in AI and cloud infrastructure and are well positioned to benefit even further. But their stock price has crashed by well over 30% recently due to rumors about overheating issue with some of their chips, and their last quarterly report also raised some concerns. So in this video, I will analyze what's behind these issues and what exactly the concerns, but also the chances for the company are, especially for long-term investors. For that, I will check their business model and markets, look at the latest financial statements, and also have a look at their valuation to see if now is a good time to buy. My name is Florian, welcome to Cashflow Maniac. Last year was a mixed year for Monolithic. Overall, they did deliver 1% total returns over the course of the year. The stock had a very good run until October, when Edgewater Research put out a report which voiced concerns about the performance of some of their chips, which could severely affect the business with Nvidia. We'll go over the details of this in just a bit. Over the last 10 years, the performance of Monolithic was still very good. Here, they could produce almost 1,300% returns to their investors, which easily beat the S&P 500 despite the recent dip. Monolithic Power Systems is all about delivering smart and efficient semiconductor-based power solutions. They design products like DC-DC converters, battery management chips, LED drivers and power modules that help to power everything from electric vehicles and data centers to industrial automation systems and even consumer electronics. Their mission is to reduce the energy and material consumption with their integrated systems and proprietary technology. This also helps them to develop highly energy efficient and cost-effective products. And in contrast to many of their competitors, Monolithic is fabless, which makes their operation very cost-efficient and flexible. When breaking down their business to the different sectors, we see that they earn 32.7% of their revenue with their products for enterprise data. This also includes products for cloud-based server applications and AI applications. 23% are done in the storage market, 90% in automotive, and the rest in the communication, consumer, and the industrial sector. So their business is quite diversified over several markets, but with currently 1/3 of their revenue, the most important market for them is the AI and cloud server market. And this was also the market that has been growing the quickest, with a CAGR of over 60% per year between 2019 and 2023. But it is not the only segment that is growing. In fact, the growth numbers in this time frame are all except for the consumer market in the double-digit range. We don't actually have the numbers for the full year 2024 yet, but the numbers from their last quarterly report do look very similar to this. While the different growth sectors have changed a bit, the total growth is with 30.6% basically on the same level as in the last few years. What stands out here is the growth of 86% in their enterprise segment. But even though the year-on-year growth has been remarkable, there was still one point which made investors nervous and started the after-earnings sell-off. And that was the decline of the enterprise market by 1.5% in the last quarter. So even though the company is up by more than 85% year over year, this trend has slowed down significantly in the last quarter. We'll come to the potential reasons and why I think that it's not so big of an issue in a minute, I promise. But first, let's have a brief look at the geographic diversification, because I think it might not be what you expect. In their last company presentation, they showed this picture. But don't let these numbers fool you. I'm not sure how they came to this picture, but when looking at the actual numbers in their last 10Q report, the picture actually looks quite a bit different. To better visualize where their revenue is coming from, I drew this graph. With this, I hope it is very apparent that the majority of the business is generated in China, which makes up even more than 50%. This is followed by Taiwan with 17% and South Korea with almost 10%. That means that their Asia business makes up more than 3/4 of their total revenue. And yes, many of their end customers are actually sitting in the US. But Monolithic is still delivering the chips to Asia and Taiwan. So, if you want to increase your China or Asia exposure without buying any Chinese stocks directly, Monolithic Power might be a great candidate. On the other hand, this huge exposure makes them quite vulnerable to a potential escalation between China and Taiwan. The overall power semiconductor market is expected to grow by 3.3% per year until 2032. But because Monolithic is mostly operating in Asia, I think it also makes sense to look at the general semiconductor market there. And this market is expected to grow with a CAGR of 10.3% until 2029 even. So overall, I expect that the market for Monolithic can grow at some rate in between these two values. That would result in a market growth potential in the mid-single digits. And even though this market is a very competitive one, Monolithic has quite a strong position here. With their holistic and customer-centric approach, they are in a great position to provide not only single chips, but also full power solutions, which is a bit of a different approach than some of their competitors. And because they are fabless, their suppliers for chip production, like TSMC for example, have a significant pricing power. And so do their customers, because Monolithic is selling mostly to large and influential companies that purchase many products from multiple sources. One of these big customers is Nvidia, and there have been quite some concerns about their next-gen AI product, the Blackwell chips. These chips have shown some overheating issues that Edgewater Research has attributed to the power management ICs that Monolithic Power is providing. Because of these issues, the market start of these Blackwell chips was delayed by 3 months. This has basically also delayed the sale of Monolithic Power chips for these products and has had a huge impact on their stock price that fell by further 25% when the report was published. And even though neither Nvidia nor Monolithic discloses any concrete information or details about their business, I would expect that this has had quite an effect on Monolithic's Q3 numbers, which might explain the decline in their enterprise segment. But these issues have been solved already, and many other analysts like Morningstar or Business Insider have voiced some doubt about the Edgewater reports. Monolithic Power themselves also confirmed that there are no performance issues with these chips for Nvidia. According to this article from Insider Monkey, they expect that the high volume shipments for these chips will start by mid-2025 and will be the foundation of Nvidia's business over the next 5 to 6 years even. I find it very likely that Nvidia is not only relying on Monolithic's power chips. But I still think that the company will benefit greatly from Nvidia's business, and the growth in the enterprise segment will continue as soon as the Blackwell production is running in full force. And that brings me to the financial situation of the company. Between 2019 and 2024, they could grow very nicely with huge double-digit growth rates. They had a revenue growth of 27%, a free cash flow growth of almost 45%, and an EPS growth of 31%. And the trend for 2025 looks very similar, even though we don't have the final numbers yet. In GAAP numbers, the company could grow their revenue by over 30% year over year again, and their net income and EPS by around 19%. In non-GAAP numbers, the net income and EPS is basically the same as their last 5-year averages. And they are also very profitable, with a free cash flow yield of 1.9%, an EBITDA margin of 28.7%, and return of invested capital of 23%. And these values have all except the free cash flow yield increased all over the board until 2022. They did get under pressure last year a bit, but with their focus on full solutions instead of just supplying chips, I think that they can keep increasing these margins even further, at least over the long run. The company also has a clean balance sheet with more cash on hand than total liabilities in their books. Usually, I'm comparing the cash to the long-term debt, but in this case, they could even pay back all of their debt, including short-term debt, with the cash they have. But this didn't come without any drawbacks, as the company has instead steadily issued new shares to finance their growth. This has led to a share dilution of 2.26% annually over the last 5 years. This is quite high, especially in an industry where most other companies are actually buying back shares. But at least they are paying a dividend of currently 0.85%. And even though this yield is not too huge, they could grow their dividend with over 25% per year in the last 5 years, while at the same time keeping the cash flow payout ratio at a very reasonable 29%. And even when looking further into the past, the company has increased the dividend by far over 20% every year since they started paying the dividend. So if you're like me and are looking for companies with a high dividend growth, Monolithic might just be the right company for you. But before we come to our conclusion, let's also check how the forecast for the next couple of years looks for them. And even though most analysts have already adjusted the targets after the sell-off in November, the 12 analysts that cover the company still see an average 1-year upside of 35%. The maximum upside is even close to 85%, while the minimum expectation is roughly at the current stock price. The EPS growth should continue to be in the double-digit space with 19.5% annually until 2027, while the revenue growth should slow down a bit to 17.5%. And even though these numbers are quite a bit below the numbers from the last 5 years that we just saw, it is still a very nice outlook. However, this growth comes at a cost. Their PE ratio at nearly 60 is double the sector median, while their EV to EBITDA ratio of 34.25 is even higher. Their price to cash flow is also quite a bit above the median. For my own analysis, I have started to use the PEG ratio more and more last year. I think it gives me a better and easier comparison between companies from different sectors and also a more complete picture than the other ratios because it considers the growth rate along with the PE ratio. So I will also start using this metrics in my videos from now on. The PEG ratio is calculated very easily by dividing the PE ratio by the EPS growth. Basically, that means that it helps me to better understand if a high PE ratio is justified by the growth of the company or not. This is not a perfect indicator, and it also brings some risks that we need to understand before using it. First of all, it is a very simple calculation that ignores other factors like debt level or mode, for example. And then the forward PEG ratio that I am using relies on the projection. So if the projection is wrong, the PEG ratio is also wrong. And because of this, it is not too suitable for companies with unpredictable growth rates or cyclicals. But because of this simplicity, it is very easy to use and understand, and you shouldn't rely on any single ratio or metrics when analyzing stocks either way. According to Peter Lynch, a PEG ratio of greater than 1 indicates that a company could be overvalued, a PEG ratio equal to 1 a fair value, and a PEG ratio of under 1 indicates that the company might be undervalued. But these values also depend a bit on the sector. For Monolithic, the current PEG ratio is 1.6. And while this alone indicates an overvaluation, it is still lower than the sector median of 1.8. And the current valuation, even though it's not cheap, is still lower than their own 5-year averages. Today, the company is around 20% cheaper compared to the 5-year averages on a forward-looking basis. Last but not least, before I sum this up and come to my conclusion, let's also compare Monolithics to some of their closest competitors. And if you find this video interesting, please subscribe to the channel so you don't miss out on my next analysis. As a small channel, this really helps me out a lot, so thank you very much. And for my peer comparison, I choose Texas Instruments, Renesas, Infineon, Microchip and Global Foundries. From this group, Monolithic has produced by far the best results over the last 10 years with over 1,200% total returns. Texas Instruments comes in at second place with still 360% returns, while the rest of the pack falls back quite a bit. And from the companies from this list that pay a dividend, Monolithic has actually the lowest yield. But instead of paying a high yield, they have focused on growing the dividend with the quickest growth of 25.5% annually over the last 5 years. As dividend payer, Microchip actually stands out here with a very high yield of 3.26% and a 5-year growth of almost 20%. Valuation-wise, Monolithic is one of the more expensive ones here. The price to cash flow ratio of the company is especially high, but when we compare the PEG ratio, the picture changes a bit. Here, Monolithic has the second lowest value after Microchip. And the reason for this is the growth. Here, Monolithic is the clear winner and has the highest values except for net income and EPS growth for the last 3 years, where Renesas has actually the biggest growth. So, to sum this up, all in all, I find Monolithic after the dip very interesting. And even though the company is still not cheap, I think that the current price presents a good buying opportunity. There is still some risk that the products for Nvidia will not perform as expected. But at the moment, it seems like these issues are overstated. Their diversified business model with huge growth not only in the enterprise segment, but also their automotive, storage and communication sector also helps them to be not too dependent on any single industry. But then, with the majority of their revenue being generated in China and Taiwan, there are also the geopolitical risks to consider. I am debating whether to switch out my position in Texas Instruments with Monolithic, because I'm starting to think that it will be the better investments in the next 5 years. And I actually also want to increase my Asia exposure a bit. But I have not finally decided yet. And that is just my opinion. What do you think about the company? Do you like it? Or do you have any alternatives that you like even better? I would actually be really interested to hear your thoughts down in the comments below. And please, before investing, do your own research and only use this video as a starting point for your own analysis. And guys, I am trying to be fully transparent about my investments and my investment strategy on this channel. That's why I share and update my portfolio on a regular basis. If this piques your interest, be sure to check out my latest update right here. That is also where I will share if and when I decide to pull the trigger on Monolithic. That being said, thank you so much for watching guys, and see you in the next video.